There we go.
Well, good morning, everybody. It's 10 a.m. Season's greetings to you, or I should say New Year's greetings to you. It's a pleasure to have you with us here in 2023. We've got a very robust schedule of programs and events this year. So this will be the first of many more to come. I want to, first of all, thank our sponsor and our host for this incredible program, our good friends at HSBC Bank, Jeff Needham and Rhonda Munoz, who have been great supporters of LuxeSF and particularly this program. It's now sort of become protocol that we kick off the year with our good friend, Jose Rasco, and we'll talk about him in just a second. A couple of quick housekeeping items, if I may. Again, you should be muted. If for any reason you see yourself on the screen, please mute your video and your audio button. The only two people who should be on the screen at any one time are Jose and myself. There is a chat button. There's actually there's a chat button at the bottom of your screen. If you've got a question that you want to pose to Jose, please feel free to pop it in there. I will be looking at it as we're talking, and if we can weave an answer into the conversation, we'll certainly do that. And finally, the inevitable question that I get, are we recording today's session? Yes, we are. We understand that particularly with realtors, you get pulled away at the 11th hour. You will receive a link to today's recording later on this afternoon via Eventbrite. So look into your spam folders and look for the Eventbrite link, and it will take you into the recording of today's program. Why are we doing today? Why are we kicking off the program today? Well, let me just read my spiel here, but it sort of sums it up. Washington, D.C. is in disarray, as we see every day. The Fed continues to threaten with additional rate increases as it attempts to throttle inflation. Global conflicts and saber rattling infect the nation's mood, and the Bay Area confronts its own unique confluence of economic, environmental, and social challenges, from the tech layoffs, which, by the way, are running about 140,000, the last number I looked at, to a very vacant downtown San Francisco. With those very comforting thoughts in mind, we kick off today's discussion. And again, for the third year in a row, we're delighted to have Jose Rasco join us. He's the managing director and head of investment strategy at HSBC Private Bank for the Americas. And the reason we love having Jose, and I personally enjoy our time with him, is that he's an economist who knows his business, but he speaks to us in language that each and every one of us can understand. Most economists, you lose them after the third sentence. So Jose, welcome back again for year 3.
Thank you very much.
Pleasure to have you.
Pleasure being here.
Let's start at 30,000 feet, and then we're going to get down to granular stuff. Got a lot of ground to cover here. Today, overall state of the economy today, what are you thinking?
Fair. We just got GDP, which was 2.9%, a little better than expected, but more than half of that growth was inventories. So fair, not great. Consumer, don't forget, we will go into a slowdown. You don't raise rates 500 basis points without having some material effect on the economy. We will have that. We will continue to see that play out in housing, manufacturing, other interest rate sensitive sectors. But remember, where we're coming from really matters. We're not coming from a weak economy with a lot of leverage. We're coming from a healthy economy, right? Which didn't have as much leverage as we've seen in prior cycles, and balance sheets look really good, overall. So
let me go through some specific subsets, if we can, and just headlines, if you will. So consumer confidence today. What do you? And by the way, what I say today going through the end of the year, consumer confidence.
Consumer confidence is not great, right? Because the market was down 20%, in excess of 20% last year. And so two of the things that affect confidence are the real economy, jobs and wages, and then the financial markets, right? Or more importantly, the asset markets. And so what we want to avoid, and what the Fed wants to avoid, is they don't want the equity markets to be down another 20% this year while we are seeing, because that's a negative wealth effect, right? not only do I feel less wealthy because my portfolio is down, I can borrow less against it. If I sell it, I get less money out. There's a negative wealth effect that's palpable. I cannot have that dual negative wealth effect of having home prices down while the market is down. That's a recipe for disaster. So the Fed wants to avoid that at all costs. Clearly, home prices are down. They do not want to push, I think, too much further on a lot of issues here, such as Fed funds, which could then cause the financial markets to topple over. I think that's something they would like to avoid for a variety of reasons. And we have the impetus behind us to avoid it. So that's the good news.
So overall confidence, okay.
It's improving, coming from low levels, but it's improving. And we think it'll get hurt during the recession, no question about, or we don't think we're going to have a recession during the slowdown in growth in the first, second, maybe even third quarter. But in the second half of the year, we see that improving, markedly.
Okay. GDP, continued GDP growth this year?
Yeah, we see continued growth. We were like 2%, 2.1% last year, down from 5.9 the year before. So the growth rate went basically from 6 to 2. That's a third of the growth, right? That's a real slowing. We see that getting cut roughly in half from 2 to about 0.8 this year. So a real cutback in economic activity on the balance for the balance of the year.
Inflation. Take us through December.
Yeah, inflation, if you look, it peaked in the PPI in the spring and it peaked in the CPI in the summer. The problem we have is the way they calculate it, right? So if you look at rental prices in many cities, they're down. They're down from their peaks. If you look at existing home sales prices, those home prices are down more than 11% from the peak. There's an inventory supply problem we can go into later, but I think inflation will continue to slow. That is not deflation, that's disinflation. We will continue to see slower inflation as we go through the year. However, food prices, the war, climate change, climate variability, lack of phosphates fertilizers. Don't be shocked if food prices surge in the occasional month here and there. The war will result in energy prices. In the spring, do not be shocked if energy prices pop up for a month or two. Retail gasoline in particular, as we have tight refining capacity in this country. Those will be negatives for consumer sentiment, and they will cut into the consumer wallet share, right, of discretionary income they have available to spend. The good news is we think we're near the end of the Fed tightening cycle, which I know we'll get into in a minute, I'm sure, but that's good news for the consumer. So we see disinflation continuing, but we're not going to get to 2% this year, but we're getting the 3-4% range. We think 4% definitely in the 4 handles.
Recession, on or off?
We think it's off. The odds have gone up, but if you look at all the major banks, they're now saying the odds have gone down because we felt they went too far in the opposite direction, right? We never felt there was going to be a recession. We think there's going to be a slowdown. Remember, in the past 6 Fed tightening cycles, the Fed has engineered 3 recessions and 3 soft landings. So it's a coin flip what they're going to do and what the desired effect is. And they've made it clear that their desired effect, their intention is to avoid recession, right? So, and we think they can, in part because we think they're pretty close to done. And secondly, the economy's healthier and we don't have as much leverage and liquidity problems in the US. So
again, bottom line on recession, not happening?
We think we avoid it. We will see rolling weakness, right? You'll see weakness in housing. You'll see part of the year, you'll see weakness in autos. You'll see those things happen. Manufacturing is weak now, but if China takes off, look for manufacturing to improve as we head toward the spring. So it's going to be rolling weaknesses in regional districts as well as, over time. But overall, we think we avoid recession nationally.
Interest rates, particularly mortgage interest rates.
So, first of all, policy rates, we think the Fed is close to done. They're going to do 25 in February, which is the next meeting, end of January to February 1st. And then we think they'll do another 25 in March. That gets us to 4.75 to 5% range on the short end. So the short end is pretty much done in terms of market rates. The long end is different. So the long end has been rallying, And we think that continues. And what that has done, which has been helpful, the reason it's going to rally is because we see weakness in Europe. We see weakness in other parts of the world in addition to the US. So people are going to look at that US 10-year and they're going to say, I can get whatever it is, more than 3% on the 10-year. You know what? I'll buy some of that. And so people have been doing that. It has rallied and long rates have come down, which obviously has made the inversion worse, right? But what that means for mortgage rates is they can come down, and they have come down in many instances, 50, 75, 100 basis points, depends on who you look at. So as a result, housing affordability is up. If you look at the MBA purchase index, it is up meaningfully in the last 2 to 3 weeks. Now, 2 to 3 weeks does not make a trend. I will grant you that. But we think lower long rates with lower inflation and slower growth globally, long rates have room to go lower.
But on the short term?
In the short term, well, we think they're going to go lower throughout the balance of the year. Yeah.
Stock market. Talk to me about volatility on the stock market.
Well, so if you look globally, we think the Chinese market is severely undervalued. And with the reopening, we think they could, like we had reopening 1.0. Let's look at this as reopening 1.0 for the Chinese, right? It's really 2.0, but let's pretend it's 1.0 because the consumer never came to that party. So we like the Chinese markets. We like the Asian markets. Europe, the winter wasn't as bad as they thought. They have tons of energy products clogging up the ports. They should get through the winter without having to ration energy. Therefore, we think, they are poised to do better than people thought. So we're less negative on Europe. And hopefully the war ends as we head towards spring. I'm not counting on that, but if it does, that would be a plus. In the US, the stock market here, we like it. It's still going to be one of our overweights. But in the short term, we have to realize that earnings expectations for this year are still too high. If you have growth going from 2 to 1, let's call it, from 2.1 to 0.8, and you have disinflation, that means margins are getting tighter. So with tighter margins and slower volumes, you don't have to have a PhD in math to know earnings are going to grow more slowly. We think they're going to head towards 0. Right now, expectations are 9%. So that's a readjustment, quite frankly, that the market has yet to make in our eyes. And therefore, that look for volatility in the US markets in the short term. But as we head toward the second, third quarter, earnings expectations in the second half of the year and next year are double digits. So we think the market improves from there.
So do we get into equities? Do we buy into equities?
Well, look, I can't tell 200 people what to do on one call, but if you ask me, where do we see opportunity? We were not as optimistic. Now we're more optimistic on China, less pessimistic on Europe. And I think once we get through this recalibration of slower earnings this year, I'm extremely optimistic in terms of the US. So if you want to be a dollar cost averaging kind of investor, yeah, it's not a bad time to look, right? If you're looking for value, find quality though. Stay very focused on quality, because as the economy slows, the companies that don't have the cash will be acquired. So
quality defined as?
Not a lot of debt and a lot of cash, or the ability to generate cash.
Example?
Well, I can't give you company examples, but if you look around, you will see, and we've done it in our weekly. I can send it to you. You can distribute it if we're allowed by compliance. We looked at sectors, and if you look, there are sectors that are doing pretty well in terms of cash, and a lot of those. If you look at the communication services sector, for example, there's a sector that how many streaming services does everybody need? I don't need 25, right? And even if I'm paying $5 a month, I can't keep up. I get a headache every time I turn on the TV because of all the stuff I've missed, right? And I have to take a week off just to catch up on the shows I was watching. So I think there's a tremendous need for content and a tremendous need for media. And I think you'll continue to see that play out. But the sector is probably due for some consolidation as margins tighten. And demand is going to lead to consolidation. And remember, these companies have cash, and their stock price, can be used as a tool to make those acquisitions for future income streams.
Gotcha. Jose, there were pieces of very important legislation passed in the last congressional period. You had the infrastructure bill, you had the CHIPS Act, you had the Inflation Reduction Act, etc. When do we start to feel the impact of what was that? I think in aggregate, $2 trillion. When do we feel that either to the positive or the negative in terms of economic performance?
Well, you know, as an economist, I love efficiency and productivity, Alf. And if you look at the government, they're the antithesis of that, right? Good buddy of mine works in Washington. He works as a consultant to the White House, right? It doesn't matter who's in it. He works with them, and he works with both parties. And so he was telling me that, believe it or not, they're still giving out money from the Obama era. Okay, so that's how efficient Washington is. All right. So that said, we should see. Usually it's about a 6 to 18 month lag to get that to hit the economy once the money has been issued. But a lot of it hasn't been issued. So I would say it's probably a late this year, early next year phenomenon. Another reason to be positive on the U.S. When it comes to legislation, though, the CHIPS Act, it's a red herring. They put $52 billion in. Whoop-de-doo. You can afford that. $52 billion is not a lot of money. If you look at the chips that need to be produced, private industry has already committed to almost 500 billion, almost tenfold, to develop chips production in the US and Mexico. So that's where the real action is.
That legislative spending, where will it first be felt on the part of the consumer?
Well, you're seeing
a new bridge, a new road, a new what?
Well, you know, infrastructure is the bane of our existence, right? Everybody knows we need it, but it's NIMBY. No, not in my backyard, and I don't want to pay for it. So I'll take the free infrastructure, but don't put it in my back. You know, so yeah, that's the problem with it. It's highly politicized. So I think you'll see some of it there. A lot of it on the ESG side, where we're seeing social capital being spent, jobs being created, and on the environmental side, where you're seeing wind turbines being put in place and jobs being created, and solar, where you're seeing solar is being subsidized by federal as well as state and local enterprises. And that's going to help that industry grow as well. I have a couple of friends in that business, and it's growing rapidly. So I think that's where you're going to see a lot of it. And in terms of the other thing I would focus on is the nearshoring theme. People have pushed it off and like, that's a long-term thing. It's not. If you look at nearshoring, we are bringing jobs back to the US. And remember, in about 7 years ago, Germany, Volkswagen decided it was cheaper to make the cars in Tennessee and ship them back to Germany than it was to make them in Germany. Okay. So in right to work states, in income tax free states, in states that are willing to play the tax abatement game, right? With a lot of them are, to get jobs in factories. You look at the Southeast, look at Florida, look at Texas, look at Tennessee. They are booming because of those things, right? Work from home, people moving all over the country. But nearshoring is important because the US is trying to get supply chain built up, not just in case, not just in time, just in case there's another pandemic or whatever. In addition, the Chinese are trying to avoid the Trump tariffs by putting product into Mexico. And then when it gets shipped into the US, there's no tariff because it's a Mexican final product. Mexico is accelerating, manufacturing and employment is growing, and that nearshoring theme is going to be a big one. So look for companies that are doing that as well.
Stay with China for a moment. The China economy, you've got Xi in for what, a third term now. You've got COVID restrictions have been dismantled. We're told that the supply chain shortages have now been loosened to a certain extent. And then offsetting all that is the pending real estate collapse. Talk to me about China and its impact, therefore, upon us here in the US.
So China's, it's a balancing act, right? And then you saw the news on the demographics where they had the first decline in their population last year in over a decade. So there are a bunch of issues, positive and negative. On the negative side, demographics are a problem, but it's not news. They've known this for the better part of 15 years. They've known this was coming. So that's not news. And that's why they're trying to lift productivity and technology to keep that GDP growth moving in a positive direction, right? Secondly, in terms of the developers and the SOEs, not a mystery. It's, again, this is a more than a decades old problem. and they are trying to deal with it. They're trying to repaper and do those mark-to-market markdowns over time, and the government is participating, and we think they will maintain control over that. So we're pretty comfortable with all that. In terms of the issue I've got with China that concerns me is when you go from neutral to first or second gear, that's okay, right? And that's what we think they're going to do. They're going to accelerate. If they go from 0 to fifth gear and they spend a ton of money and they boost infrastructure spending, you could see commodity prices take off. You could see logistical issues and supply chain issues come back to the forefront, and that could lift inflation around the world. We don't think that's going to happen. We think that's an unlikely scenario in 2023. So that's the good news.
Stay with supply chain. In the US, have we solved that problem? Is product flowing freely now, or do we still have bottlenecks?
Well, so the problem, not to use the word the Fed used, it's sort of temporary, but it really what sort of was, but temporary in a sort of like a geological sense, right? It took a couple of years to work through this temporary phenomenon. And the problem we have is you had demand went down dramatically. We printed a lot of money and handed it out and said, go spend. And people did that. And then, yes, with all that spending on the same goods, it led to inflation and it led to bottlenecks. Not surprising. And it happened around the world. So I think as COVID abates and as it becomes more endemic rather than pandemic, and we're seeing that all over the world now, thankfully, right? Now, hopefully the war ends soon and we can restore stability to global supply chain issues. We have seen slower demand and better inventory control and better technology in the ports, especially in this country, has definitely alleviated that problem. But again, it's a knife's edge. And if China begins to grow excessively, you could see that thing rear its ugly head again, and on the margin could affect inflation as well as inventories.
But right now, across the US,
yeah, it's okay.
It's okay.
Yeah, and no, but don't forget, we're not buying goods like we used to, right? I mean, I've got 2 patio sets. Right. I don't know what to do with the second one. I don't know why I bought it. So I can invite all of you to have this next conference in my backyard. I don't need the other patio set, and a lot of people are seeing the same thing. I want to go on trips. I want to go to the movies. I want to go to a restaurant. And yeah.
Jose, we're very apolitical as an organization, so I really don't care whether it's Democrat, Republican, or independent. Having said that, you've got a significant handover now in the House of Representatives with McCarthy and Republicans. Should we assume that nothing of significance is going to be legislated in the next 2 years? Is obstructionism going to be the new mantra, or will we see something happening that will have an impact upon our economy?
Oh, I think that remains. Obstructionism and gridlock remain the words of the day. Yeah, and that's been the case in American federal politics for over a decade, right? So I don't think that's going to change materially. And I think, I forgot who said it, but somebody said we have managed to weaponize every single item on the agenda, and that remains the case today. So I think politics remain problematic on both sides of the aisle. Now you've got executive orders on the Democratic side that they can certainly execute. The House will clearly block anything they can, right, to prevent Biden from looking good before. Because don't forget, after the election, what happened? The presidential race began the next day, right?
Right.
So we're already in the middle of that. And I think it's clear that the Republicans want to block Biden. And I think you'll see a lot in terms of investigations and things like that. They've made that clear. In terms of major policy announcements, I would look for more deficit reduction, okay? And I would look for some form of stimulus to try to get passed in 2024, because they both sides of the aisle want to look like they're helping people. And I think it's about maintaining that illusion. And so I think they will try to do something there, but I don't think it's going to be major, because deficit reduction on the Republican side remains of paramount importance.
What about the debt ceiling limits? Do you think there'll be a certain amount of dissonance and agita, but that'll go away by June?
It may not be June, but I think they will find a way to make us suffer. And they're going to want their time on TV, right? They're going to want their 15 minutes of fame every day, and I think they will work that to ad nauseum. So I don't think that's going to go away anytime soon. But at the end of the day, you have to come up with an agreement, and I think they will. And they already know what they have to do. They're smart people. They know, and so they know what they have to do. They're just going to work it.
Both sides.
Both sides, yeah, both sides know it's gamesmanship. It's brinksmanship, right? Republicans want deficit reduction, and the Democrats want less spending on items X, Y, and Z. So it's going to be a tug of war to see who wins out. But at the end of the day, it'll get passed. Because the ramifications of not passing it are not good.
And you don't see any diminution or hurt to the nation's debt rating coming out of this fracas?
That's up in the air. I think we'll get warned more than once between now and then. And I don't think we'll see an actual decline in our debt rating, long or short term. Right. But I think we will get warnings. But remember, when we go to these emergency powers that Treasury is going to execute, right? That will have real ramifications. Your IRS refund check, if you get one, it'll take longer. Social Security, take longer. Medicare, Medicaid reimbursements will take longer. People will get hurt. Parks will get closed. Federal facilities will be open 1 day a week, not 5. You're going to begin to feel that pinch, and that is by design. Okay, they want us to feel the pain, so we put pressure on them to find some sort of conciliatory middle ground.
I want to go over to sort of current socioeconomic trends, if you don't mind, Jose. Sure. The first one is this notion of quiet quitting and the great resignation. Is that temporary, or is that a sort of a seminal change in the way people build careers in this country? And will that have an impact? If so, will that have an impact upon economic trends for the next 12, 18 months?
No, I think it's a seminal event. I think people have changed the way they look at work and work and where they work, right? How they work, where they work, and when they work. And so especially the youth of this country, I think, is looking at the situation very differently. And the whole concept of having a career and working there for 50 years, that died when we were getting a job, right? Today, the concept of and don't forget, there's a huge transfer of wealth that's taking place, right? From the earlier generations, the great generation, to the younger generations, and it's skipping the boomers and all that. So that is also having an effect. You're seeing a transfer of wealth. You're seeing tremendous wealth creation, whether it's private equity or the markets. And then you're seeing, in addition, the rise of wages, right? Wages are rising at double the rate they rose at in the last business cycle. So all that combined with work from home, combined with COVID, and crime in the cities is having a major effect on how younger people view their careers. Yeah.
So how does that affect our economy?
I think the economy is going to have to be more flexible, and workers are going to have to be more flexible. And I think you're going to see that that's going to continue what I call the great migration, right? Where people are moving from high tax, expensive states to low tax, less expensive states. And I would say the losers are states like New York, California, and the winners are places like Florida and Texas, right? Where we see tremendous, migratory patterns in one direction, so not surprising. And I think that will continue over time.
Jose, I call these sort of the mind droppings. You can't open your computer nowadays without seeing something from Peter Thiel or Elon Musk or Jeff Bezos, whoever. You've got this billionaire class that insists upon communicating to the community at large what goes on inside the recesses of their brain. Does that have any impact upon the overall economy of how we make and spend money, or are those just idle reality television substitutes?
Well, a little bit of both, right? I think some of those people are just, talking their own book, and some of them are just, the ego. Just because you're rich doesn't make you smart, right? But to some people it does. And so there's some of that. There's no question. And there's
but just to interrupt, when Elon Musk talks, people listen. When Berkshire Hathaway talks, people listen. Is there any long lingering impact from that?
Well, but don't forget, I remember I used to work at a company called DRI McGraw-Hill, And our chief economist was so egomaniacal that he said, I can't forecast a recession because if I do, it'll happen. And I thought that was the most mega maniacal thing I'd ever heard. So I think, but all that aside, yes, people have followings today. And a lot of wealthy people who have been successful have followings along the political spectrum, right? And I think that's going to continue. And it's going to affect clearly, but on the margin. I think the key thing is people need jobs, and want better wages and healthcare. And I think that's going to continue regardless, All
right. We're going to get into the Bay Area in a moment. But every time I read the headlines in the San Francisco Chronicle, it's another restaurant closing. It's another it just seems that there's a contraction taking place particularly in terms of small business closings. Are you feeling that? I mean, what's your feeling on that? What is it? Should we be concerned, number one? And secondly, where should the concern be?
Yeah, so there are secular forces, in other words, long-term forces at play. And one of them has been the move out of major cities to second and third tier cities and out of major cities to rural, residential, suburban areas, right? And both of those trends are reversing to a degree, but not to the degree that people who live in these cities and the mayors of those cities are comfortable with, right? I keep seeing every day, I see another headline of a new CEO who says, no, working from home is not good. We want people to communicate face to face. I want you in the office. And they argue over productivity, work from home versus work in the office. So clearly the cities need people to come back, and those big cities need people to buy sandwiches and coffees and go to expensive restaurants. So that's still an issue. And that's a long-term secular change that it will mean revert to a degree, but not totally, I don't think. And secondly is the cyclical issue where rates are up 500 basis points at the short end, and we're beginning to feel it. And then home prices rose dramatically, rental prices have risen dramatically, and big cities are feeling it. But what's interesting is if you look at the downturn, prices in big cities are down. Prices in second and third tier cities are down a lot more. Because remember, during the rise up, major cities were up 10, 15% in terms of price appreciation. Second and third tier cities, where there was limited supply and people were moving because they wanted to get lower taxes or health or whatever, prices there were up 30%, 40%. So that's where you're seeing the real snap is in those smaller cities that really bounced,
So 3 years after COVID, are there any industry sectors that have been permanently disrupted or taken out of business? Or will everything come back in some form or another over a period of time?
Well, you look at the airline industry, right? I mean, that has been severely dislocated. The cruise line industry, right? Another one that has been severely hampered. And I think you'll see consolidation in all those markets. And that's part of what I think M&A last year fell off a cliff. It was down 16% year over year. I think you'll see more consolidation as we go forward in the slowdown and then in the recovery of that slowdown. So consolidation is the word. And I think you're going to see it in a lot of those sectors that were affected by COVID. And they are bouncing back, but remember, at a higher cost structure with less demand. So, it's going to be a problem. And I think consolidation is going to be one outgrowth of that. Yeah.
I know that you have strictures on you in terms of what you can recommend and what you can't recommend. Keeping away from brand names or from specific companies, are there sectors that you see as opportunistic in the next 12, 24 months that you think are going to come on like a wildfire?
Yeah, I think one sector that has done really well in the last 2 years is energy. I think that'll continue to do well because while demand is going to slow in the US, demand is going to stay healthy in Europe, and it's going to accelerate in China. Materials companies, if China does accelerate as we think it will, and we took our numbers for next year up from 4.8 to 5.8 in terms of GDP. So I think next year China accelerates more than this year. I think material companies that make lumber, copper, aluminum, hard goods, soft goods, those should do well. Food companies should do well. As I mentioned before, climate change, climate variability, lack of phosphates, fertilizers, the war, food prices are up. and then they're slowing, but they're still at very healthy clips. So I think energy and basic materials continue to look interesting. But again, you want to focus on quality companies, right? And then in terms of tech, because I know you're going to ask me about tech and real estate, right? In terms of tech, I don't think we're quite there yet. I don't think we're quite there. We need to see that realignment. Those job cuts are a good step in that direction. And a more realistic assessment of earnings for 23, number one. Going into 24, tech earnings look very optimistic. That's the consensus view, and I think that makes sense. So if you want a dollar cost average, tech's an interesting place to look at for good value, right? But you have to be patient, and it's not going to happen in a day. And then the other question is real estate. And I think if you look at that sector, it's the national market doesn't exist. The national market is a whole host of small markets, regional markets, right? And so if you look at the national market, though, let's pretend there is one, higher rates and higher prices have really hampered residential activity. But remember, people are responding to lower long rates already. And we've seen those, the MBA purchase index rise. We've seen investor sentiment, home buyer sentiment begin to rebound as well. So I think you will see a quicker snapback than some of the pessimists. We're talking about a multi-year correction in housing. It's already been close to a year. It's like 9 months already. So I think, we should begin to see that change as we get through this year. On the residential side, in terms of office, that adjustment continues, and that's a secular trend. And then commercial and industrial, I think very different markets, obviously, but as the economy slows, they will get hampered or hurt by that and then look for that rebound. So again, I think it's very different in each area, but slow going in the first half of the year, hopefully improving as we move forward on the calendar.
And that's an ideal segue into the Bay Area. I want to spend our remaining time talking about Bay Area. From an overall perspective, how optimistic are you about the Bay Area economy?
Well, if you look at the Beige Book and some other indicators of local activity in the region, pretty mixed, right? I mean, pretty mixed. You're seeing manufacturing activity, like other places, has slowed, right? Residential construction, very weak. And you're seeing that even on the commercial side, a lot of weakness there as well. So according to the Fed and other sources that we look at, the Bay Area, the 12th district, looks like it's like the rest of the economy, struggling with higher rates and tighter margins. And so I don't think that's going to change. Now, based on some of the sectors that are very prevalent in that area, in your area, right? Real estate has been a source of growth and tremendous income. Now, remember, the dollar was up a ton, and that should have attracted capital. And I think it will continue to attract capital, but it is falling relative to the pound and the euro. So look for that to continue to be a trend. So that's one potential negative in terms of inflows of capital. Now, if China reopens and if there's improved terms of trade and all that, I think you could see more inflows from Asia in terms of capital inflows. And I've already spoken to a series of clients who are asking that question. I want to invest in the US. What do I have to do? I want to establish long-term positions. And with the equity markets still not where they should be, is this a good time to do it? And they're starting to do that. So that's one piece of it. In terms of real estate, I think it's going to follow some of those trends that large cities and residential real estate are going to suffer from across the country. I don't think you're going to be any different there, but you have the advantage of having the Bay Area is a very tight area in terms of floor space. And as a result, it doesn't move like other markets do, right? Similar to New York in that respect. So I think that's one thing. But in terms of the IT industry, I think we're still in for another leg of reassessing, unfortunately. And I think job cuts and more realistic assumptions about what earnings are going to look like this year and the next 3 to 5 years, that has yet to happen. When that happens, I think you'll see a more realistic assessment on those stocks, and I think they can do better. And so I'm a long-term optimist on the technology sector for a variety of reasons. We could do a whole hour just on that, but I've talked about blockchain, digital markets, AI, all kinds of other digital data, tremendous trends that are out there, right? Healthcare, et cetera. And I think the area will boom in that regard, but not for a while still.
Go back for a second. You said you saw investment inflow. From where and into what sectors?
Well, we're talking to clients who want to establish positions in U.S. markets, right? So Asian clients in particular who are saying, hey, I'd love to be in the U.S. market, and with the market being weaker, this might be a good time to enter, right? And so we've seen clients talk about that. And so they are looking
the equity markets. When you say markets,
equity markets, yes. And then increasingly, as we go through a slowdown, you're going to see people say, hey, wait a minute, I'd be willing to buy at these levels. And that would be residential, right? So I think you will see residential, but you'll see people, they will pick up bids. I don't think it's going to happen now, but I think as prices continue to fall, you will quickly see that people will come in and try to acquire those assets at more reasonable valuations. So
residential real estate market in the Bay Area should start to capture some of that Asian money coming back.
Yeah,
where it was 5, 6, 7 years ago.
I don't know if it's going to be that kind of flow, but it's going to be I think it should be a positive flow before year end for sure. Yeah.
I was going to ask you about tech. I saw the number. I think this number is correct, Jose. It was 141,000 or something retrenchments or layoffs in the tech sector in the Bay Area. Mm-hmm. I assume that those layoffs are because of overhiring as a result of COVID?
So it's the result of many things. Overhiring because of COVID, overhiring because of unrealistic assessments as to where the market was going and where earnings were going. And then a reality check. Remember now, as the economist joke goes, everybody likes to swim in the nude until the tide goes out and then things get ugly, right? And so I think that's true here. So companies made assertions about earnings that at 0% policy rate made a lot of sense. Now the policy rate is 5%, or it will be, we think, in 30 days. So if that's a very big difference, that's 500 basis points of reality check, right? And so when you have that moment and you sit with your CFO as a tech company and you say, hey, projects X, Y, and Z, they made sense, a year ago in February of last year. And then the Fed started to raise rates in March. Here we are 500 basis points later. What's my cost of funding? What is my IRR on that project? And what's the ROI for my investors? It's not going to be as dramatically positive as it was last year, right? And some of those projects get canceled and some of those projects get delayed or get reduced in size. And that's the reassessment that I think tech has to go through. And part of that is these layoffs, unfortunately.
This is outside the scope, but let me ask the question, where do those 140,000 people go? Understanding, of course, that in the Bay Area, those were the people who were entry-level buyers at $1.5 million to $2 million, particularly for downtown condos. What happens to them now?
Great question. And if you look at initial unemployment claims, right, usually what happens is when companies announce firings, and it doesn't happen immediately because most of those firing programs are, we're going to fire people on December 31st. You say we're going to fire people by March, right? You give a date, right? And it's usually not the next day. But we have seen unemployment claims go down. So people are getting fired, but they're not claiming unemployment insurance. So clearly there's a couple of things that have to happen. Number one, with a lag, people will go to the government websites and they will start claiming unemployment insurance in the next couple of weeks or months. That will, we think, will definitely go up. That's number one. Number two, remember, these markets are really, really hot. So I am looking for a software engineer. I can't find one. All of a sudden, there's 141,000 people who are unemployed. I may be able to find that person, right? Sure. And so that may be a factor here where the market was so, dry in terms of finding qualified people. Now, all of a sudden, some of those people are loosened up. You can fill those voids. So therefore, claims may not go up as much as we think, and people may get jobs. Now, they may not be for the same wage, may not be the same career path, etc. But you will see people that will probably remain employed, and it'll help fill some of those vacancies that were out there for months and quarters.
We've got about 10 minutes left here. I want to get you off a little early because I know you've got back-to-back calls. Let me just go back to commercial real estate and office buildings. Latest number I saw, 27% of downtown San Francisco was vacant. And then you've got a lot of extended lease, 5 and 7 year leases that are coming due in 23, 24. What does that mean? Do the downtown areas come back, or are they being perpetually harmed?
In the middle. I think it comes back with a lag. If you look at what many companies are doing today, is they're saying, I'm buying at X per square foot from you. I'm leasing at X per square foot from you. You know what? I'm going to cut my square footage by 50% or 25%, and I'm going to go get it in the building next door for 30% less. And I'm going to lock that in for 5 years. And that's what a lot of companies are doing. So downtowns are getting renovated and reinvigorated, but slowly. And then developers in New York, I've seen a fair amount of it. We're seeing that developers are saying, hey, all this office space, guess what? I'm not going to sell this for the next 3 years. So I'm going to renovate this. Floors 1 through 3 are going to be retail. Floors 4 through 20 are going to be residential. And they're re-permitting, rebuilding, and they're renting them out pretty quickly. So you're going to see a combination.
Do you see a conversion from commercial, from office space and commercial buildings to residential?
Yes, we're already seeing it.
We are. That's yeah. Definite.
Yes. I'm not saying it is the trend nationwide, but we're definitely seeing it happen.
Jose, the rest of the country, Manhattan, where you are, Florida, I'm thinking the sort of the robust real estate territories, Texas, of course. Are you seeing the same trends there as we're seeing in the Bay Area? Is it pretty much universal?
No, I think we're seeing continued flight. I work with this one salesperson in our building, in our bank, who covers upstate New York, Buffalo, Rochester, Syracuse, Albany, upstate, and the western part of New York, into the Midwest. But the New York contingent in particular, I would say about 1 out of every 4 clients that we used to go visit in Buffalo, I have to go to West Palm Beach now to visit that same client. Okay. So, or Jacksonville or Austin. So we're seeing a huge migration into states that offer lower or tax-free income.
So what does that tell you then about the economy going forward?
People continue to migrate. I think this American migration is not a COVID thing. I think it's much bigger than that. It's social, legislative, Supreme Court decisions, right? Violence in the big cities. All these things are having an effect, and people are moving. They're migrating. If I can work remotely even part of the time, I'd rather work somewhere warmer and cheaper, right? Where I don't have to pay taxes. That's just common sense. And then regulatory changes are massive. So if you have a disagreement on a particular issue, whether it's gun control or abortion or other issues, you're going to want to move to a state that's in keeping with your views, right? Even environmental, social justice, we're seeing huge differences between states like California, Florida, for example, and you have to move where you're going to be comfortable and happy.
Where you're with your own tribe.
Yeah, so to speak, yeah.
A couple of final questions. The wealthy. How are the wealthy behaving? Are they spending more? Are they spending less? Are they moving? What are the wealthy doing?
Well, what tends to happen with the wealthy during periods like this is their spending doesn't really fluctuate like everyone else's, number one. Number two, what they look for is they look for that moment when there's, as the Baron de Rothschild said, look for when there's blood in the streets, right? And so they look for those value plays and they look for those opportunities. And that's why I think that real estate in particular, I can tell you our Latin American clients, the question I get every single time I talk to a client from Mexico or Chile or Brazil, when is it good to invest in US real estate markets? They want to put money in these markets. So I think that continues to be a factor. And they will look for those values to acquire. They love the dollar cost average and buy low and sell high. So they're smart and they have the dry powder to wait it out.
And Jose, how are you defining wealthy? I know how I am, but how are you defining wealthy?
Well, for us, if you're in a private bank or a high net worth bank, it's somebody who has millions in terms of, assets under management, right? So, then it doesn't, you're not talking Bill Gates and Warren Buffett. Those are billionaires, right? But anybody who has, between 2 million or let's say or more are very wealthy people, right? And then, there's different subsect, 2 to
The
10,
ultra high, right?
and the ultra high would be 50 or so and above. But the ultra high in particular are going to wait to look for those values and go and acquire those. Yeah.
Quickly, is crypto dead?
Wow. Is crypto dead? No. I think what is going to die a quick death is unknown users. And if you remember, we've done a couple of these things, you and I.
Right.
And I've had some friends with me as well who have helped define the space. Blockchain is booming. Digital business is booming.
Booming where? Blockchain is booming where?
Across the world. And so I think if you look at what is hurt is if you're going to buy a currency where you don't know the other people you're buying and selling from. That business is going to be legislated out of existence. And if you want to do it, you're going to be in like a black market kind of environment, right? That's increasingly obvious that the regulators will not tolerate that, because that it increases volatility, it increases losses, it increases the use of those assets to do bad things to people on multiple fronts. So they're going to legislate the heck out of that, and they should. What's going to continue is blockchain rather, and digital markets, which are going to continue to expand. We're going to digitize buildings and people and income streams, and we're going to fractionalize them so you can buy percentages of these things. And that is going to continue, and that is going to become a market unto itself. That is going to continue. And I think you're going to see it particularly in the emerging markets, where if you have a gold mine in your country, in Alfland, rather than sell the gold to some rich people in London or somewhere else around the world, you can take that gold, put it in a bank, collateralize it, you get a fund, and go create economic development. You repay that debt, you do it all over again. So that asset can be used in perpetuity.
Do you ultimately see federal regulation that will prevent something like the FTX fiasco?
The problem with that is criminals are creative, right? And so if you're going to commit fraud, you can just find the loopholes and try to find a way through them. But the regulators are working hard and fast to close those as soon as possible. And we're big fans of that, because we think the future for the digital markets is huge. We've been in it for a while, and we have our venture bank has been in that for quite a while. And we think they're going to continue to regulate it, and it'll get safer. And I think you'll see that returns will be good in the future, but it's going to take some time to clear out this mess. But remember, this was not a Lehman moment. Lehman was a $2 trillion experience. This was a Lehman moment that was 2 billion. It's a very different animal. And don't get me wrong, at the end of the day, the counterparty risk could be in the multiple, it could be 10, 15, 50 billion, but that's a long way from 2 trillion. So it's a big event, but it's not going to derail us.
Final question, if I may, and we've got 2 minutes before I lose you. For the people watching right now, I always ask the question, what is the canary in the mine shaft between now and December? And we don't have time to investigate and to research like you do, Jose. What should we be looking out for?
Geopolitically, the candidates are all over the map, literally, right? The war in Ukraine, that hopefully that de-escalates and we get a ceasefire, not the opposite. But that's a risk that we do get the opposite, right? I think those risks are, the obvious candidates all over the world. You know them. Politically, internally, gridlock, the potential for some sort of problem with the debt ceiling passage over time. That's a huge risk. I don't think it's going to happen because the negatives are too monstrous, but it's there. In terms of the markets, I would say that recalibration of earnings, if that does not happen in due course, that could derail the markets or maintain volatility for longer and therefore create further problems in the market, right? I don't think, a lot of people talked about the Fed. We think the Fed stops after March and they pause and they see what they've done for a period of time. That's consistent with their history and it makes sense given the rhetoric. And so that is another risk, that if inflation picks up, they go back in and start tightening again. So those are the risks we see, right now that are obvious. There are a whole bunch of others. Europe, could that get worse rather than better? Liquidity in the banking system in Europe in particular is one that concerns me. And the good news is we're seeing spreads widen out, but they're not blowing out, which is a sign that a recession can probably be averted, and there doesn't seem to be a systemic crisis. Remember, the Fed did a stress test last year in June, and they took the unemployment rate from 3.5 to 10. Residential prices were down 60% in this test. All 34 banks in the US passed. They all maintained their tier 1 liquidity ratios. So the US economy is well levered, not well levered. It's liquid enough. We're very well capitalized. And I think we're in decent shape to go into this slowdown, which permits us to hopefully keep it short.
Jose, I'm very, very proud to be a member of the Rasco tribe. I enjoy the advice you give us every time. We will do this in 2024. I want to thank you very, very much for your time today and for the articulation of what is normally very confusing. You bring it down to something that adults like me can understand. To our audience,
thank you.
There will be a Zoom recording link coming out this afternoon. Please look in your spam folders, folks. I get a million emails saying I can't find it. It's in the spam folder. It'll come out through Eventbrite, and that'll be a recording link for today. And I want to just let you know that on the 23rd of February, 2023, we'll do a follow-up program on the Asian and the foreign global investor and buyer into the United States, because exactly what Jose was talking about today, we're starting to feel at a sort of at a granular level in the Bay Area. That money is starting to come in. So we're going to be doing a program on the 23rd of Feb on that very subject, and you will get the announcements out there. Jose, thank you very, very much again. I know you've got another appointment.
Thank you.
And to everybody.
Do me a favor, if anybody has any questions, reach out to Rhonda and Jeff and myself, and let's get on the phone and help you with any questions, queries, or if we can point in the right direction on something, let us know. We're here to help.
That's fit. All they've got to do is email me, and then I'll just funnel the questions through to you. And with that, ladies and gentlemen, we are adjourned. Thank you, Jose. Thank you, y'all. See you in February. Ciao.
Thank you.